I think the next time we have a growth phase, so the next time we have rising PMIs, rising economic indicators, things like that, I think there's a good chance that inflation would return with it. Um, and so I think the kind of the base case I'm looking at this decade is higher average inflation. Now, whether or not we get up to another period of like 9% is unclear, because that
Mm.
was, that was like 15% deficits, and injected kind of right into the middle of the economy. Whereas I think what we could experience is a longer and grindier type of inflation.
Popular macro analyst and founder of the Lyn Alden investment strategy, Lyn Alden believes the inflation battle is going to be a continuous exercise in the United States, at least for the rest of the decade. According to Alden, the Federal Reserve, using its current set of tools, might be able to get inflation to drop lower for a brief period of time, but it will continue to return on a much larger scale until the central bank gets things right and begins to use the right tools to combat the right type of inflation. In her July 2023 newsletter, Alden examines the issue of fiscal dominance and how large debts and deficits can mute the impact of higher interest rates as a policy tool. In the newsletter, Alden identifies two main causes for higher than normal broad money supply growth, which typically tends to lead to higher consumer prices. The first cause, Alden notes, is rapid bank lending, which can be influenced by a large number of the population needing a lot of credit at the same time. Alden explains that this kind of inflation occurred in the 70s as the baby boomers began entering their home-buying years, meaning a lot of rapid lending from banks. The second cause of higher than normal broad money supply is large monetized fiscal deficits. Alden notes that this tends to be tied to conflicts, such as the First World War of the 1910s, the Second World War in the 1940s, and the COVID-19 pandemic in the early 2020s. The financial analyst explains that these unusually large fiscal deficits and new money creation are not tied to bank credit creation, and such cannot be reduced by controlling bank lending, which is what the Fed is doing right now by raising interest rates. Essentially, Alden believes the Fed is tackling a 1940s-style inflation by using tools suitable for a different type of inflation, similar to the one they had in the 70s. To make her analogy clearer, Alden adds two important charts showing the rate of loan creation and fiscal deficit in the 70s and now. Bank lending was going through the roof in the 70s, necessitating a higher interest rate environment. In contrast, the recent period has been marked by increases in year-over-year federal debt, much higher than year-over-year bank loan creation. What does this mean for the United States economy? What happens to inflation if we keep attacking it with the wrong tools? And what are the proper tools to combat the current inflationary environment? Alden properly discusses these issues and more in a recent interview with Blockworks Macro. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell so you never miss any of our subsequent uploads. Also, ensure you drop your comments and observations in the comments section below. Thanks and enjoy the video.
So a lot of people, they have recency bias when they think of inflation. Almost everybody thinks about the 1970s. It's basically, it's like, okay, how do you get inflation down? You become Paul Volcker and you raise interest rates, and that's kind of the axiom that people operate with inflation. But when we look back in history over more countries, more sample size in terms of length, we see that there's actually multiple different types of inflation. There's different causes of inflation. And I think we can kind of put that into three categories. The one category that's present in all the different ones is that there's some degree of supply constraint. We don't have infinite resources. So if you had infinite resources, like let's say our entire economy consisted of software, you might not get corresponding price increases with increasing the money supply. So generally, what you see in times of inflation is that you run into some real world constraint. In the 70s, for example, U.S. oil production peaked in 1970 after almost like a century of just almost every year's up, structurally up, and so we became more reliant on imports, which made us more geopolitically exposed, and so that was a constraint that then made so that larger than normal money supply growth does have pretty tangible consequences. So that's always a factor, and it takes different forms. But then the other two factors are the other side of the equation, which is generally an expansion of the money supply. And then the question is, where's that expansion of the money supply coming from? And there's really two main ways that money supply in the modern economy happens. And the one that most people think of is bank lending. So as velocity increases, as loan creation increases, we get more and more IOUs, basically deposits, chasing a similar amount of goods and services, and so you get inflation. That was in the 1970s. That was the primary driver of money supply growth, loan creation, because you had the baby boomer generation, which was born starting in the late 40s, early 50s. They were turning 25, 30 throughout the 70s and then into the 80s, where they were entering their home buying years, which is when people start making use of credit. So due to demographics reason, we had like higher than normal rates of loan creation, so fast money supply growth, and then you added on. I mean, you had significant fiscal deficits. They weren't huge, but they were there. And then you also had the oil problem, so you had a big toxic recipe for inflation. Whereas you look in other periods, the other driver of money supply growth ends up dominating, which is fiscal deficit. So if you have large fiscal deficits, especially if they're monetized by the central bank, then it doesn't really matter if banks are lending or not. Money's just being handed out. It could be handed out in stimulus checks. It could be handed out in soldier salaries. It could be handed out in, stimulus to build new manufacturing plants. Whatever the case may be, it's going out into the economy, and it's being created from new reserve creation. And so when you get those large fiscal deficits, that's it's a similar end result as money creation, except the causes are different. And that's what we saw in the 1940s, and that's what we saw here in the 2020s so far, which is that the inflation in those eras was not because banks were lending at a higher than normal rate. It was because the government was running larger than normal deficits to respond to what they perceive as a crisis.
Having thus far established that this is not the right inflationary environment for higher interest rates, Alden notes that the Fed will keep at it because that's the only set of tools in their toolbox for combating inflation. Here's an excerpt from the newsletter. An issue here is that the Federal Reserve doesn't really know what else to do because their tools don't really address deficit-driven inflation. Their tools are meant to deal with lending-driven inflation. It's a fiscal matter, and so the best the Federal Reserve can do is try to suppress the private sector to offset some of what's happening in the public sector, even though that's not addressing the core problem. In her newsletter, as well as in the interview with Blockworks, Alden points out another difference between the 70s and the current period. This is no other than the federal debt to GDP ratio, which is currently over 100% and makes interest rate hikes even more unsuitable. In the newsletter, Alden writes, raising interest rates when the federal debt is over 100% of GDP substantially increases those deficits at an equal or larger pace than it reduces loan creation in the private sector. So as the Federal Reserve raises rates, federal interest expense increases, and the federal deficit widens ironically at a time when deficits were the primary cause of inflation in the first place. It risks being akin to trying to put out a kitchen grease fire with water, which makes intuitive sense but doesn't work as expected. Let's get back to the interview as Alden further analyzes the situation and how it will impact the inflation trend going forward.
The challenge there is that the tool of raising rates is primarily effective at trying to slow bank lending. It makes it less attractive for people to borrow money, and therefore can potentially suppress that excessive rate of money growth. But if large government deficits are what's driving inflation primarily, then higher rates don't really tackle that because governments are relatively rate insensitive. They don't usually say, "Oh, well, now because bond yields are 5%, we're going to get together and we're going to trim the military budget." It just doesn't really happen. And so in practice, you have a rate insensitive source of money creation, and the best that higher rates can do is offset that. So you could suppress the private sector enough that you get inflation down temporarily, but you're not actually addressing the core problem. It's like, it's like one kid ate too much, so the other kid, you have to give them half the food so that your average food per child is the same, right? It doesn't really, you're not actually addressing the problem, which is the one kid ate the other kid's food. Um, and so that's kind of the approach that they're doing because the Fed doesn't really have other tools. It's mostly a fiscal problem, and central banks aren't really in the political position to say, well, it's not our problem. Maybe they should, but that's kind of where we find ourselves in, which is that this is mostly a fiscal driven inflation, and the tools that address it are mostly fiscal, not monetary. And a lot of us in this space, like the digital asset space, and also in adjacent spaces like the gold space, part of why we're in this space is because we think the current system is unsustainable. If we thought it
Mhm.
was sustainable, we might not be in these spaces. We might be in the existing space. And one of the challenges that makes this environment, say, different than the 70s, going back to the fiscal versus lending concept. So in the 70s, the federal government had 30% debt to GDP. And like I said, most of the money creation was happening from bank lending. So when they raised rates, it would increase the interest expense from the government, which is in some ways stimulative. Ironically, it's pouring money into the economy, but that was a much smaller impact than it would have dampening that loan creation. Right, so it wasn't
Mm,
an effective inflating fighting tool. The problem in, say, the 40s or the 2020s is that if you have over 100% debt to GDP and your deficits are what's primarily causing inflation, then raising rates actually increases your deficit, and it increases the deficit at a higher rate than the impact is likely to have on loan reduction in the private sector, because you're expanding a bigger thing faster than you're reducing the smaller thing, which is loan creation. So you get this kind of period where it seems like it's working at first because you're putting pressure on the private sector, you're slowing things down, but then you're building this structural new source of money creation, which is all of these larger and larger deficits pouring into the economy. And so I just think it's a very challenging political position because we don't really have we don't really have the bipartisanship to address the budget directly. And then the central bank doesn't really have the tools to address it, but they have to act like they're doing something. They don't really have the purview to say this is not our issue. So they have to kind of act, even if the act itself is not actually attacking the direct problem. So I think in the near term, disinflation is still winning, but
mm,
in part that battle's being prolonged, I think, because basically you have, on one hand, you are squeezing the private sector, but on the other hand, you are actually exacerbating the public sector. And
mm.
so, part of why a lot of these recession forecasts and kind of transfer inflation forecasts haven't materialized as quickly as some people thought is because we're getting to the point where this is actually somewhat stimulative, and it's offsetting some of its own effects. So I think that in the near term, disinflation's winning, but slowly. And I think the bigger risk is that the longer this goes on, eventually the private sector kind of normalizes,
Mm.
whereas the public sector deficits are still there. And then I think we get another wave of inflation in the years ahead. And that'll depend on various factors. Basically, I think the next time we have a growth phase, so the next time we have rising PMIs, rising economic indicators, things like that, I think there's a good chance that inflation would return with it. Um, and so I think the kind of the base case I'm looking at this decade is higher average inflation. Now, whether or not we get up to another period of like 9% is unclear, because
Mm.
that was like 15% deficits, and injected kind of right into the middle of the economy. Whereas I think what we could experience is a longer and grindier type of inflation. Now, obviously, things like acute energy shortages or war or you know tail risks can always give you crazy numbers. But
Yeah.
in general, I think the theme we're looking at is higher deficits, and then structurally deficit-driven inflation, kind of throughout the developed world, and especially kind of centered around the United States, in the decades that follow.
According to Lyn Alden, the rest of the decade will be marked by higher average inflation because the real underlying problem will continue to go unchecked. The underlying problem here is the fiscal deficits, and higher interest rates will only contribute to that. According to Alden, the higher interest rates, the money does get back out into the economy, exacerbating the underlying issue. In her own words, when you have higher interest expenses and overall larger deficits from those higher interests, about a quarter flows out of the country. Another chunk goes into the Social Security Fund, and some of it goes to the Fed, which is currently operating at a loss because its liabilities are yielding higher than its assets. So the money that goes to the Fed actually goes out to the banks. The rest, the larger share, is the part that is owned by domestic sources, including insurance companies, banks, pension funds, and large wealthy holders that own bonds, and that includes a lot of retirees who will now be getting more income on their retirement funds to spend on travel, restaurants, and lavish weddings for their grandkids. This essentially means that the money does get out to the economy. In her newsletter, Alden also notes that interest rates were not used as a policy tool to fight inflation in the 1940s. Instead, the primary policy tools focused on ending the war, ceasing the fiscal deficits, and pivoting back towards a period of financial austerity. What are your thoughts on Lyn Alden's analysis of the Fed's rusty inflation playbook? How do you think the economy fares going forward? Please drop your comments and observations in the comments section below. Also, ensure you give this video a thumbs up, subscribe to the channel, and turn on post notifications for more videos. Thanks for watching.